On Thursday, the 30th of April, 2026, the United States Commerce Department unveiled its advanced estimate for first quarter gross domestic product. The headline showed 2% annualized growth, rebounding from the mere 0.5% expansion recorded in the fourth quarter of 2025, a period weighed down by a 43-day federal government shutdown that had curtailed economic activity. Wall Street had projected growth of 2.2%, yet the economy came in at 2%. At first glance, the small shortfall led financial media to label the report as solid. That label, however, was misleading. Buried deeper within the same release was the Personal Consumption Expenditures Price Index, the Federal Reserve's favored measure of inflation, and this figure transformed the GDP narrative from a minor miss into a genuine warning. The PCE Price Index for March 2026 registered an increase of 3.5% compared with the previous year. 3.5% inflation during a quarter when GDP slightly lagged expectations, and when consumer spending data showed, according to the Commerce Department's own breakdown, that nearly half of the monthly spending increase came from energy costs. That phrase holds the key to understanding what follows. Almost half of March's growth in consumer expenditures was not channeled into discretionary items, services, experiences, or investments. Instead, it went toward energy, gasoline for vehicles, electricity and heating fuel for homes, and transportation costs embedded in every item purchased at grocery stores, hardware shops, and fast food drive-thrus. This type of spending does not drive economic expansion in the traditional sense. It simply allows households to maintain their current standards of living. When energy inflation, propelled by conflicts in Iran and $100 oil prices, absorbs such a large share of household budgets, the funds left for restaurants, vacations, school supplies, and other discretionary purchases shrink sharply. This contraction underpins the warning issued by U.S. Bank's chief economist, Beth Bovino, who summarized the forecast with 2 words: sadder summer. She explained to the Washington Post that while tax refunds provided temporary relief to households, in real terms, little remained. As May, June, and July approached, American consumers were set to confront a period of tangible financial strain. These 2 words, simple yet precise, capture the mechanistic reality of a consumer sector that has been living beyond its means for 3 years. The brief reprieve from tax refunds had temporarily lifted consumption, but the underlying pressures were about to assert themselves. To comprehend this coming summer, one must examine the American household balance sheet entering 2026 and how it has been eroded. The pandemic period created an extraordinary deviation in household finances. Stimulus payments, enhanced unemployment benefits, student loan pauses, rental assistance, and forced reductions in discretionary spending during lockdowns allowed Americans to accumulate roughly $2.3 trillion in excess savings beyond pre-pandemic trends by the end of 2021. This surplus underpinned resilient consumer spending that sustained GDP growth throughout 2022, 2023, and 2024, even as inflation eroded wages, and the Federal Reserve raised interest rates from 0 to 5.5%. Federal Reserve research, including studies from the San Francisco and Boston branches, confirmed that this cushion had been exhausted. San Francisco Fed economists estimated that excess savings were fully depleted by the third quarter of 2024. With savings gone, households, particularly lower and middle-income groups, turned to credit. Total U.S. household debt reached $18.8 trillion in the fourth quarter of 2025, up 4.1% from the previous year. Credit card balances climbed 5.5% year over year to all-time highs. LendingTree's analysis indicated that credit card debt had surged $57 billion since the first quarter of 2021, when balances bottomed at $770 billion during the pandemic, marking a 66% increase over 5 years. The average household carrying unpaid credit card balances now faced roughly $7,886 in debt, an increase of 8% over the prior year. 11 states recorded averages above $9,000. Annual percentage rates on these balances stood at 21%, with cards accruing interest slightly higher at 21.52%. This means a typical household paying interest on revolving balances owed about $1,657 per year, equating to approximately $138 per month in interest alone. These payments generate no new purchasing power, create no economic activity, and leave household financial positions unchanged, a compounding cost for the 3-year period of credit-fueled consumption that replaced the pandemic savings buffer. The timing of these factors crystallizes the sadder summer scenario. U.S. consumer behavior follows pronounced seasonal rhythms visible across retail and credit card datasets. January and February traditionally register the weakest spending months as households recover from holiday expenditures. March and April, however, receive a predictable boost from federal income tax refunds. In the first 10 weeks of 2026, the Internal Revenue Service issued roughly $124 billion in refunds. 3.3% higher in nominal terms than the previous year. Deposited between early February and mid-April, these refunds temporarily expanded household budgets and fueled the Q1 GDP uplift. The boost, however, was largely funneled into energy and essential spending. Energy costs accounted for nearly half of the monthly spending increase in March. Food away from home rose 4.1% in 2025, energy climbed 7.4%, and healthcare services jumped 6.7%. These categories are not discretionary. They represent the costs of maintaining current living standards. Once the tax refunds were spent, the cushion vanished. Middle and lower income households, already relying on high-interest credit cards, faced record debt and rising energy costs. Meanwhile, the labor market, expanding by only 178,000 jobs with a 4.3% unemployment rate, was stable but insufficient to drive wage growth that could offset inflation. This imbalance is reinforced by distributional dynamics. The Minneapolis Federal Reserve's March analysis revealed a starkly K-shaped recovery in consumer spending. Higher income households have maintained robust growth, while lower income groups stagnated. Moody's Analytics reported that spending by the top 10% of households surged 62% between the third quarter of 2020 and the third quarter of 2025. Conversely, the lower third saw stagnant or even shrinking expenditures in mid-2025, with minimal growth into early 2026. The result is a sharply divided consumer landscape, where headline GDP growth masks the uneven reality. Many Americans face the prospect of a summer defined not by leisure or investment, but by the relentless cost of simply keeping up with daily life. The consumption pattern shaping 2026 resembles a K, where the top quintile, with annual expenditures averaging $151,342, propels aggregate spending, masking the struggles endured by the bottom quintile, which averages only $29,046 annually. This disparity keeps headline consumer data artificially elevated, concealing the financial strain that affects 60 to 70% of households. Data collected in March 2026 revealed that 72% of global consumers remained worried about rising prices for everyday items. This concern is overwhelmingly concentrated among lower and middle income groups, not the top 10%, who, according to Moody's Analytics, expanded their spending by 62% over the past 5 years. The sadder summer does not pertain to wealthy Americans. They are largely unaffected. Rather, it is a warning for the majority, whose spending depends on credit cards bearing 21% interest, and whose Q1 gains from tax refunds have already been absorbed by energy and essential expenditures. Verified, undeniable, the forthcoming strain will emerge first in discretionary spending categories, beginning with those easiest for households to delay or forgo when cash runs short. The Q1 data already reflect this hierarchy. Goods expenditures fell even as services spending rose in January 2026, continuing a post-pandemic trend where services, particularly social experiences like dining, concerts, and travel, maintain resilience because households are reluctant to cancel pre-booked commitments. However, this deferral strategy has limits. When a credit card balance reaches $7,886 and the minimum monthly payment at 21% interest hovers around $200, households confront a rigid financial boundary. Deferred discretionary spending cannot be postponed indefinitely. Consequently, the first visible signs of a sadder summer will appear in restaurant and entertainment receipts during May and June, in summer travel cancellations, in retail sales of non-essential goods such as apparel, furniture, and electronics, and in credit card delinquency figures captured in the New York Federal Reserve's Household Debt and Credit Report. The delinquency metric to monitor is the transition rate of credit card balances from current to 30-plus day delinquency. This rate has trended upward since 2022, and, as documented in prior analysis, now sits at elevated levels, reflecting the late stages of the consumer credit cycle described by Dimmond as worse than people think, and translated by Bovino into the sadder summer scenario for May, June, and July. Historical parallels illuminate the mechanism at work. The first is the mid-2008 consumer spending deceleration. This period closely mirrors the present, marking the point at which credit buffers sustaining above-income spending were exhausted across enough households to trigger a consumption collapse that, combined with the financial crisis, precipitated the Great Recession. In the first half of 2008, headline spending remained positive due to a 2-month lag between financial stress and consumer response. The February 2008 stimulus payment of $600 per taxpayer issued by the Bush administration temporarily boosted second-quarter spending. Beth Ann Bovino could have applied the same observation to those payments as to the 2026 tax refunds. The stimulus provided short-term relief, but in real terms, little remained. By the third quarter of 2008, consumer spending fell at an annualized rate of 3.8%, and by the fourth quarter, the decline deepened to 5.8%. The sadder summer of 2008 unfolded roughly 3 months after the one-time fiscal boost was depleted. The structural parallel to 2026 is clear. A temporary fiscal infusion followed by energy-driven expenditure, culminating in the exhaustion of credit capacity and the ensuing slowdown in consumer spending. Verified and undeniable. The second parallel is the 2011 consumer stagnation, instructive because it illustrates how energy shocks, rather than financial crises, produce a sadder summer. The context then involved labor market recovery, not collapse, making it the most precise analog to 2026. Brent crude traded above $100 per barrel due to geopolitical unrest in Libya and broader Arab Spring instability. The energy spike eroded purchasing power, mirroring the Iran war-driven energy pressures in 2026. Real personal consumption expenditure growth in the second quarter of 2011 was virtually flat at 0.1%, rising only to 0.2% in the third quarter. Consumer confidence hit its lowest point since the recession. Even as unemployment declined, the mechanism was identical to 2026. Energy costs displaced discretionary spending, leaving households with nominally growing incomes, but effectively no increase in purchasing power. The 2011 sadder summer eased when oil prices moderated mid-year as the Libya crisis stabilized. In contrast, the 2026 scenario offers no guaranteed oil price relief, with Iran war ceasefire talks delayed by the Tuska seizure and the formalization of dual blockades. Verified, undeniable. The third historical parallel is the 2022 and 2023 retail deceleration, which provides the most recent directly comparable precedent for 2026. In 2022, depletion of pandemic savings combined with inflation surges to create the first genuine squeeze on consumer purchasing power in over a decade. Real personal consumption expenditure growth slowed from 4.3% in 2021 to 2.5% in 2022, and further in early 2023. The household savings rate fell to its lowest since 2005, with lower and middle-income households drawing down reserves first, as confirmed by San Francisco Fed research, which documented that liquid wealth from pandemic excess savings was depleted faster among lower income groups. The K-shaped spending pattern of 2022 and 2023 foreshadowed the same distributional imbalance visible in 2026. Higher income households maintained robust spending, while lower and middle income households shifted from savings to credit. This credit, now totaling $1,277 billion at 21% average interest, reflects the cumulative impact of 3 years of households funding consumption beyond their incomes, absent the savings buffer, exhausted by the end of 2024. Looking forward, 4 specific data releases in May and June 2026 will either confirm or challenge the Bovino sadder summer forecast. First is the April retail sales report, coming mid-May, which will capture the end of the tax refund boost period. It will reveal whether households increased discretionary spending or if refunds were entirely absorbed by energy and essential costs, leaving no real improvement in purchasing power. Second is the May University of Michigan consumer confidence reading, scheduled for the third week of May. The most recent index stood at 58.6, the lowest since the depths of the COVID recession. Any further decline would confirm that households are entering summer with a posture aligned with spending pullback. Third is the first quarter household debt and credit report from the New York Federal Reserve, which will detail credit card delinquency transition rates and show how rising debt interacts with 21% interest rates to strain household finances. Fourth is the May retail sales report, released mid-June, capturing the first full view of the sadder summer dynamics. A decline in May retail sales compared with April, particularly in discretionary categories such as apparel, restaurants, and electronics, would validate the 2 words that Beth Bovino delivered to the Washington Post on April 30th. The specific segments of retail most vulnerable to the May and June slowdown, as outlined in Bovino's framework, are now starting to show strain. Leading indicators are already visible in the earnings guidance from major retailers and restaurant chains, reflecting what executives are witnessing in their real-time transaction data, a consumer sector heading into the sadder summer. The warning issued in 2 words now finds its explanation in the data. The June spending reports will determine whether the diagnosis holds true. As May, June, and July unfold, the economy is revealing the stark reality of households that relied on credit to navigate 3 years of energy and inflation pressures. A 21% interest rate on credit cards and a one-time tax refund offered temporary relief, but when applied to gasoline and groceries, it left virtually nothing to spend over the summer months. This phenomenon has a geographic dimension, exposing specific states and local markets more acutely than national averages suggest. Connecticut leads the nation with the highest average credit card balance among households carrying unpaid amounts, at $9,778 per household, followed by New Jersey at $9,748 and Maryland at $9,630. These are not economically fragile states. Rather, they are regions with relatively high household incomes. Yet, living costs, including housing, at 33.4% of total household expenditures, according to the Bureau of Labor Statistics, Consumer Expenditure Survey, transportation at 17%, and rising food and healthcare costs have forced households to spend beyond the growth of their incomes. Washington State recorded the fastest growing credit card debt nationally between Q3 2024 and Q3 2025, with average balances climbing 11.8% year over year, from $886 to $9,390. South Dakota rose 11.7%, and Nebraska 11.3%. These states are not typically linked to consumer financial stress. The rapid accumulation of credit card debt signals that middle-income households in economically active states are leveraging credit to maintain spending standards, while energy costs and inflation diminish real purchasing power. The sadder summer will first manifest in these states' retail sales, where the middle-income consumer cohort's depleted credit buffer is most pronounced. The Los Angeles gas station charging $8 per gallon, photographed on April 28th, exemplifies the extreme energy spending pressures straining household budgets. On April 29th, U.S. Bank data reported the national average at $423 per month, meaning the typical American commuter driving 30 miles daily in a vehicle achieving 25 miles per gallon is paying roughly $450 per month for gasoline alone. That represents an additional $125 per month compared with the sub-$3 per gallon environment that Energy Secretary Chris Wright suggested may not return until the following year. Each additional $125 per month in gasoline expenditure is money unavailable for restaurants, retail purchases, or summer travel. Scaled across 70 million American households commuting by personal vehicle, that extra expenditure equates to roughly $8,750 million monthly in discretionary spending diverted to energy costs. This reallocation forms the quantitative foundation of the Saturn summer. While GDP reports 2% growth, households experience an $8,750 million monthly drain.